Hello, everybody. Today we have another chapter to talk about. This is a relatively important one because it has to do with how you approach cases in specific constellations. Our topic today is just how to deal with barter trade. What's barter trade? Barter trade is simply my personal label for anything where you don't get paid in money, cash, bank transfer, or so on, but get something else in return. So you do something and you are getting paid with a delivery, so you get an object, or you get a service in return, or you get a service plus delivery plus an additional payment or so everywhere where a part at least of the consideration which you get is not cash is by us now labeled as barter trade. Now the question is, often these things are highly confusing on the first glance. However, let's make it simple. So, is there a convincing trick to a solution of these cases? And the answer is naturally, otherwise I wouldn't have talked about this in this video. There is a general principle, which you probably find in every tax law worldwide, apart from very, very small exceptions. From an economic point of view, it can make and must never make a difference if you get cash and then spend that cash to buy something, or if the matter is simplified and you immediately get that object which you would have bought. There can be no difference. So, no difference possible between getting 23,800 in cash and then spending it for buying a car for that price, or immediately getting a car with a value of 23,800. So the second case must be viewed as just abbreviating the first case. And that means wherever you are paid with an object or with a service, you have to do as if you got that money first in cash and then spend it for buying the other stuff. And this seems to be a very widespread principle. At least it has to be, because wherever a state deviates from that principle, the behavior of the citizens of that state would be distorted. Imagine that barter trade would be treated in a better way, financially or under the tax aspect, than exchanging cash and buying things for cash. Then everybody would turn to barter trade, and in the end, half of the population or even more would live in the Stone Age again, because everybody would insist in barter trade and nobody would accept cash. So an easy general principle can be set up. Wherever there is barter trade, you have to do as if you had got cash, the market value of what you get in return in cash. Yeah? So you just have to change what you get, exchange it for the market value of what you get in cash. So that principle will always lead to convincing solutions. The example is here relatively small, printed in very small print letters. However, imagine a simple barter trade transaction. You have a lawyer. He takes care of a complicated lawsuit of a car trader, and in the end, well, the car trader is not so well off, so he says, just accept a new car in return. This car has now a market value of 23,800. So we have to do as if our lawyer, let's say he's from Leonberg in Germany, gives advice to the car trader in Düsseldorf. What he gets is a car, and that doesn't count, so we transfer the car immediately into that difference sketch. The lawyer gives advice and he gets paid by something having a value of 23,800. We do not need more, because that's always what we need. The entrepreneur, his customer, what is happening, a delivery or a service, and then later we need the tax base, so the consideration. And then we need to know if 23,800 is a gross price or a net price. Well, that's just according to the usual formulas. 23,800, if you sell something, the cash which you get is a gross price, so we have to deal with that just according to the usual testing scheme. Now it's easy. Taxability, the lawyer is an entrepreneur. He acts as a lawyer. Giving legal advice is his main business. He acts for consideration because he wants something in return, not cash, but a car. He has a service, and the place of the service is to be determined according to the usual rules. 3A2 is the usual rule where your customer is an entrepreneur. The place of the service is where the customer has established its business, or his or her business. So we end up with Düsseldorf. It's taxable because Düsseldorf is in Germany. There is no exemption, which we could see. Then we go to the tax base. That's by the legal definition in 10.1. Everything which you get, so 23,800 minus the VAT amount included therein, if there is a VAT included. So we end up with a net amount of 20,000. The lawyer has to pay 19,000, that 19%, that's 3.8, and taxpayer is the lawyer because the lawyer gives legal advice. And so the entrepreneur, the lawyer, has to pay the VAT on the transaction. There is, if you have understood that first rule, a second one, which comes on top for barter trade. In case of a barter transaction, you always have two things which happen. The one guy gives here a service, the other gives away a car. So you have two things which happen. So the second advice, if you want to organize your sketch for a barter trade situation, is split the barter trade thing up into the two separate underlying transactions and then assess both of them separately. So let's practice this a bit. We have again the lawyer from Leonberg. He gives advice to a car trader in Düsseldorf and gets a new car in return. You already heard that. The advice would usually have a market value of 24,000. By the way, good entrepreneurs would not do this. Usually you would have no deviation between the market value of the two things exchanged because nobody is generous to somebody else here. However, I make slightly different value so that you can better see that you always have to look on the value not of what you give away but what you get in return. So that's the only reason why I have deviating values for the things which they both exchange. Clever, careful, and ordinary business people would not accept deviating prices. However, this makes things a bit clearer for you as beginners. So our initial sketch is just confusing or shows everything. We have a lawyer, we have the car trader, the lawyer gives advice for 24,000, the car trader gives a car in return for 23,800. This has now to be split up. Let's look to the next slide. So we have this again and we split it up. We have first transaction, a lawyer gives advice to the car trader. And nicely put, he gets paid by something which has a value of 23,800 in return. Then, second transaction, the car trader sells a car to a lawyer in Leonberg and he gets in return something, a service which usually has a market value of 24,000. Well, after you made this split up, then you can now just deal with two separate transactions where you have all the necessary information in the two sketches. Yeah? So everything is easy then. There are some special rules in the German Tax Act mentioning barter trade. However, if you look on them, they are simply superfluous. In paragraph 10 on the tax base, you know 10.1 is everything you get minus the VAT amount included. And from the formulation there, from the expression there, you can already see everything you get. Naturally, you have to express that in a monetary value, and then minus VAT included. So no problem whatsoever. Just a clarification is in 10 to sentence 2. In case of barter trade and similar transactions, and in case where you first fix a price and then accept something else as a replacement for the price, so an object or a service, then the value of what you actually get is seen as a consideration for what you did. That's just the same as in 10.1, just only to clarify it if somebody is an idiot or so, or just as a matter of precaution. And then the paragraph mentions that there's barter trade and transactions similar to barter trade. That is, that's just a terminological peculiarity. Barter trade in the narrower sense is just if you exchange a good for another good. Everything else, if you exchange a good for a service for a service for a good, and so on, would not be barter trade, but a transaction similar to barter trade. However, we should not make this distinction because basically it makes no sense, it's not necessary. So we among us should just label barter trade as everything where you are paid by something which is not in cash, wholly or partly. And as these things are basically unnecessary, I would recommend you to know these rules, but then forget them again. You don't need to deal with them actively. You don't need them to solve cases, so forget them. So, just to sum up, if you have a barter trade transaction, easy principles how you approach the case. First, you do if the entrepreneur in question got the market value of what he gets in cash, and then you make clear to yourself that a barter trade transaction usually has two separate transactions underlying. A gives something to B and B gives something to A, and so two transactions have to be checked if you are asked for them. Might be that you get a barter trade situation and somebody says, I'm only interested in A delivers to B, the other thing is not my problem. However, if you want to have a comprehensive overview over the situation, then naturally you analyze both transactions. Just to illustrate that, imagine you have a computer trader from Cologne, Germany, and he asks a software expert from Solingen, also in Germany, for help with a software problem in the computer programs of his store. In return, now the software expert is allowed to take home a new computer with a price of 400,000 euro, 420, oh my god, for free. Now the computer expert worked 3.5 hours and would normally just have charged 100 euro per hour, VAT included. The divergence in the prices, that's just to simplify for you the situation. Under normal circumstances, you would never have that. Under normal business persons, 420 value would be exchanged for 420 value because business people don't make presents to each other. The world is not for free. Nobody can afford to be generous. However, in our cases, they all are a bit generous to each other because that simplifies keeping things apart for you. Otherwise, if both pay 420, then you never know, is it the value of this or this? So let's begin. We have the software expert, Solingen. He gives his work to the computer trader, so he solves problems, and perhaps if he's a very average computer expert, he also will create some new problems by his work. He is paid with 420 euro because that's the value of what he gets. Number two is the computer trader sells a computer to the software expert, and what he gets is advice with a value of 350. So if we want to analyze this, here's the solution for transaction 1. The software expert works for the computer trader, gets 420 in return. Taxability is to be tested first. Software engineer is an entrepreneur, acts as entrepreneur is for consideration because he wants something in return. What he does is a service, and the place of the service is where the customer has established his business. That's in Germany, so taxability in Germany, yes, we have it. No tax exemption is visible, so fully liable to tax. The tax base will be all he gets, that's 420 minus the VAT included therein, if there is a VAT included therein. Under the law, there is a VAT amount, so the net amount is 420 divided by 119%, that's 352.94. The tax is 19%, that is 6706. Taxpayer is a software engineer because he renders a service and he has to pay the VAT for this service. And everything else is as usual. The next transaction, so the other underlying transaction, the computer trader gives away a computer. He gets 350 in return. Taxability, yes, it's a delivery. The place of delivery is where the transfer of the computer towards the customer or by the customer begins. That's Cologne in the shop. No exemption. He gets 350 minus VAT included therein. That's 294.12. The VAT is 19%. Taxpayer for this amount is the computer trader, and everything else unchanged. Another example. Let's imagine, again, owner of a computer shop wants to buy chocolate for a marketing campaign. Sometimes the ideas of teachers, professors, and so on are rather desperate. However, I have special reasons for constructing this example. So our computer trader now orders chocolate with a market value of 321 from a shop in Düsseldorf. In return, the owner of the grocery shop who sells the chocolate gets a computer with a market value of 300 plus VAT, which he wants to give to his son for Christmas. So let's make a sketch. We have a grocery shop owner who sells chocolate. It's a delivery to a computer trader and gets 357 in return, VAT included or on the price. Computer with 300 net value plus VAT is 357. Second transaction is computer trader sells a computer to, not software expert, sorry, to grocery shop owner and gets chocolate in return. Let me just adjust the slide here. So the mistake has been corrected now. Now you see it correctly on the slide. It's a grocery shop owner and naturally not a car trader or something else. He pays with chocolate with a value of 321. So solution to transaction 1. You see now two completely different cases in your sketch. And you treat them as two completely different cases which have nothing to do with each other anymore. So if we look to the first transaction, chocolate is sold by a grocery shop and he gets 357 in return. Taxability, yes, grocery shop owner is an entrepreneur, acts as entrepreneur, demands a consideration. What he does is the delivery of a good, namely delivery of chocolate. The place is where the movement of the chocolate towards the customer begins. That's in the shop, that's in Germany, that's taxable. There is no exemption visible for chocolate. Chocolate tax base is everything he gets minus the VAT amount included therein. He gets 357. VAT amount for chocolate is 7%, not 19%. So 100 out of 107% of 357 is the net amount, 333.64. Tax rate and tax is 7%, 23.36. Now your subconscious will probably revolt and say, well, yeah, but 357, computer 19% or so, but the answer is no. The tax rate on what you sell is decisive, not the tax rate on what you get. If you sell chocolate, you always pay 7%. Whatever you get, cash huh? Or a computer, or what else, or a car, or a holiday, plays no role. You sold chocolate, so the tax rate you have to sell on the chocolate sale is 7%. Taxpayer is the shop owner because he sells the chocolate. Everything else works just as usual. Transaction number 2, the computer is sold and the seller gets 321 in return. Taxability, yes. Tax base is now 321. The computer is sold, so the VAT amount is 19 out of 119, because if 321 is a gross price, then it contains 19% out of 119% VAT, and only the remaining amount is the net amount. So here we end up with 51.25 VAT on the sale of the computer. Everything automatically works fine if you split up the sketch into different transactions and treat them completely different. Nothing can go wrong anymore. Let's make an example which is a bit more complicated on the first glance. A computer shop owner from Cologne now wants to have the facade of his shop painted. For this reason, he gives an order to a painter, and the painter comes from Poland because that's nice and makes the case a bit more challenging. This painter, who would otherwise have charged 5,000 euro, instead accepts 2,000 in cash plus a computer with a value of 3,000. He wants to give that computer to his aunt in Aachen, Germany, as a present because I just liked the idea. So we have a painter from Poland, and he paints a facade that is for the computer trader in Cologne. And he gets paid by 3,000 in kind plus 2,000 in cash, so he in total gets 5,000. Number 2, we have the computer trader. He sells a computer to the painter from Poland, and he gets paid by a price reduction of 3,000. Instead of 5,000, he only has to pay 2,000 in cash, so 3,000 is the price reduction. That is what our computer trader gets for selling the computer. Now you have again two absolutely separated cases. You can analyze the first according to the testing scheme. You can analyze the second. Everything's fine. Let's do it quickly. The Polish painter paints a facade. That's service. The place of the service is according to the German rules where the building is located. That's Cologne. That is taxable. There is no exemption which could be seen. The tax base is all what the painter gets here, 5,000 minus VAT amount included therein. However, as it's a foreign entrepreneur rendering a service to a German entrepreneurial customer, paragraph 13b, the so-called reverse charge rule applies. Don't forget that foreign entrepreneurs are sometimes or most often not the taxpayers if they give services to inland entrepreneurial customers. So what he gets is a net price by definition. VAT is not included therein because the customer has to put the VAT on top and pay it himself to the fiscal office. That leads to a tax of 950. The taxpayer is the Cologne customer. So the computer trader in Cologne. 13b, subparagraph 2 and number 1 in combination with 13b5, which says the 13b rules apply if the customer is also an entrepreneur, so somebody who has decent knowledge of VAT and can be expected to fulfill VAT obligations. The second transaction is a computer trader sells a computer to a Polish customer. That Polish customer pays with 3,000, and now the question is, well, what happens to the computer? Is there perhaps a tax exemption? Intra-community delivery? No. That would require that the computer goes to Poland and is acquired for entrepreneurial purposes. In my case, I just wanted to spoil that by saying he buys it for private purposes. He wants to give it as a gift to his aunt in Aachen, Germany. So we don't have an inter-community delivery here. So the 3,000 is by definition a gross price because it's taxable and liable to tax. So 3,000 minus VAT leads to a net amount of 2,521. The tax is approximately 489. The taxpayer is also here the computer trader, because this is not a case of 13b. Because here the computer trader is an inland entrepreneur having to pay taxes to the state of Germany, and 13b would be unnecessary, complicated, and wouldn't work. So here just the regular rule applies. Case solved. Again, a last example. Again, our computer shop owner needs something. He needs a new car. So he goes to the car trader and selects a new car with a gross list price of 35. It's, however, usually sold with a discount of 20% on the gross list price, so for 28. The car trader accepts the old business car of the computer shop owner with a value of 18,000 plus an additional payment of 10,000 in cash. So the car trader sells a car to the computer trader. He gets in return an old car for 18,000 plus 10,000, so he gets 28. The computer trader sells an old car of his business to the car trader. What he gets is a price reduction of 18,000, not more, because the usual market value of the new car would have been 28, and that he hands over his old business car only leads to a reduction of 18,000. So that's the consideration which he gets for handing over his old car. Now we have again two absolutely separate transactions, the first and the second one, and if you want to solve them, just look on the first transaction first and on the second time. And so you just go through the usual testing scheme step by step. So with the data in sketch 1, the first part of the sketch, you can analyze the first transaction, and with the data contained in the second sketch, the second one, different prices here, everything, however, is fine. It's always the same approach. So whenever you deal with barter trade things, two simple rules, nothing more. First, what you get is changed or expressed in a market value in cash. Second, barter trade things always contain two transactions, so you make a sketch where you put them down to both. A does something for B and gets this and this in return. B does something to A or for A and gets this and this in return. Once you wrote down these data, this information separately, everything can no longer go wrong. Then everything is plain and simple, and that is your guideline to get through with all barter trade things, wherever they might show up in the future of your VAT career. Okay, that were my hints for today, and I thank you very much for watching today, and I hope you come back to the channel soon. Till then, have a good day. Goodbye.